Main of import and export from Libya country. Libya major export are crude oil, gas petroleum and refined petroleum, while Libya major import are including machinery, transport equipment, foods and manufactured goods. North Africa is the home of the nation of Libya. It is the fourth largest country in Africa and the 16th largest country in the world, with a land of area of almost 1.8 million kilometers. The Libya economy is almost entirely based on the sale of oil and gas petroleum. The country is the major global producer of oil. The exchange rate for Libya currency is 4.78 Libyan dinar. Libya introduced its own currency, the Libyan pound, only after the country gained its independence in 1951. In 1971, after the establishment of the central bank, the Libyan dinar replaced the pound.
Proceed with theoretical literature. According to Edward 1989 model of real exchange rate determination, this model captures most of Earth's temperature of small operable on economy, including the existence of exchange and free control. According to Roderick 2008, economic growth can negatively think positive changes and exchange rate when the high financed by import, which are no countries to the productive capacity of economy. The expectations are higher than any improvement and value of the dinar to USD will the cost major charges in GDP. To Rearhart and Rogo 2010, when debt in advanced economy exceeds 90% of GDP, there is an asserted dramatic worsening of growth outcomes. Others dispute the notion that there is such as clear their whole and suggest there is weak growth that cause high debt ratio than high debt and cause weak growth. According to Rodriguez and Rodriguez 2001, several changes in interest rate of rates between economy will result in increase in demand of local product and increase in demand of foreign currency and of trade.
Price level is thought to be one of the most important economic indicators. Long-term high inflation rates can have a negative impact on the economy. A situation of continual price increase over a predetermined time period is referred to as inflation rate. In Libya, an oil exporting nation, the native currency have seen a very significant nominal devaluation, which may theoretically result in substantial inflation. Inflation was brought on by a significant local currency devaluation, with significant real exchange rate undervaluation. It is expected to rise. Economic growth that is heavily financed by imports that do not increase the economy's productive capacity can be negatively correlated with positive changes in exchange rates. This argument is based on the notion that higher levels of productive capacity are typically linked to high-quality goods that can be produced at the reduced cost and offered on the global market for cheaper price. Moreover, stable economies are sometimes linked to highly productive economies. So it can be claimed that advance in Libya's economic performance have a favorable effect on the dinar's exchange rates to the US dollar. The implication is that in order for the Libyan dinar to achieve a high and steady value against other currencies, the Libyan government's consumption must be focused on purchasing products that are productive. This should be supported by encouraging the growth of the financial industry by allowing it more freedom to expand. The demand for local products will rise as a result of favorable developments in trade relations between economies, which will also raise demand for the local currency. The relative measure of export price in respect to import price is referred to as term of trade in this study. The majority of Libya's economic problems have substantially materialized as fluctuating exchange rates, which is seriously impeding export and import initiatives.
Next, we proceed the description statistic of Libya. The table shows the higher means its term of trade is 183.7734, while the lowest its inflation rate is 4.9052. Furthermore, the table shows the higher of standard deviation its term of trade is 58.1886, and the lowest Libya dinar is inflation rate 9.0161.
Government spending related to currency rate and inflation had correlation values of 0.4763 respectively. It is regarded as having a positive correlation. We can explain that as inflation and government spending rise, so does the value of Libyan dinar in relation to the US dollar. Gross domestic product GDP is equal to 0.3135. As a result, both variables exhibit a positive association with the exchange rates. We can infer that a rise in GDP and trade terms will result in decline in the value of Libyan dinar against the dollar.
I will continue this presentation with multiple regressions. First, for model summary, the value of R square is equal to 0.63 to 1. It means that the government spending, inflation, term of trades and gross domestic product about for 63.21% of the Libyan dinar exchange rate. Meanwhile, value of adjusted R square is equal to 0.5504 or 55.04% of the variation exchange rate variability. The dependent variable slightly explained by the independent variable. Next, coefficients. The significance of this figure suggests that the gross domestic product and government spending have a considerable positive influence on the exchange rates. Hence, the null hypothesis is disproved, and the alternative hypothesis is accepted. The null hypothesis is accepted despite the fact that terms of trade and the inflation have little impact on the exchange rate. Last but not least is ANOVA. The p-value of the f-test is equal to 0.0008, which less than the level of significance 0.05. Therefore, the null hypothesis is rejected. This means that the inflation, gross domestic product, term of trade, and government expenditure is statistically significant variable in explaining the variations in the exchange rate of Libyan dinar.
In conclusion, the study has analysed the inflation of domestic product, government expenditure, and term of rate has affected the Libya currency, which is Libya dinar, against US dollar in the long run. Dual exchange rate of the domestic currency tends to make more export more competitive abroad, while seeking to make important product with less competitive due to increase in the market of demand for domestically manufactured goods services. Hence, predicting future exchange rates is crucial for evaluating the risks and the benefit associated with the global economy.